Hey everyone, welcome back to the Daily Gold Podcast. Today we're catching up with Dave Skarica of AddictedToProfits.net. And Dave, we're seeing a pretty good move in the gold stocks, and especially relative to the metals. Gold and silver, I believe they're up today, but they're not that far off their bottoms yet. You look at the mining equities, they've had a pretty good rebound. So what do you think is in store over the next couple months? Obviously, we have this rebound, but what are your thoughts on a potential retest? I mean, should we be worried with everything that's going on that the retest could make a new low, or should we be more optimistic that we're just going to see some backing and filling that would set up, I guess, the next cyclical bull market in the gold stocks?
Yeah, I think that this is what's happened is really, really positive here. We're seeing, firstly, I think you have to look at it this way. The gold is roughly up 5% since its low made a few weeks ago, and the gold stocks are up 25%. So it looks like we're finally seeing that turn where the gold equities are going to outperform the gold stocks, similar, to what happened after the 2008 or 2004 bottom. So I think it's the first thing you have to look at. Now, with me, if you look at the 2004 bottom, you had an all-out retest in early 2005, or same thing, the 2006 bottom, you had an all-out retest in the fall of 2006 before each of those markets rallied for roughly the next year to 2 years. With this, I'm looking at this because the stocks got so cheap compared to the metal. You look at like the 2000 bottom in the gold stocks, or you look at the 2008 bottom. I'm looking for us to see a continuation of this very quick rally, made to the 500 to 550 range on the HUI. And then, from 372, which is the low, to say, let's say we go to 520, that's roughly 150 point bottom rally. I would look for something like a 50% retracement. Like, for example, in 2008, we went from about 150 on the HUI to double, run over 300, then pull back to 250. So really rallied 150 points, then only took back about a third of those gains. So because we got so oversold, and the oversold was more similar to the 2000 and 2008 bottoms than it was like 2002 or 2004 or 2006. I'm not looking for an all-out retest. I'm looking for more like a two steps up, one step back type pullback. But I assume that's probably going to happen over the summer or maybe into the early fall. And then we get ready for maybe the really big breakout to happen later this year or early next year.
Okay, and before talking about macro fundamentals for gold and silver, I want to talk about fundamentals for the stocks. And Dave, one reason why the stocks could be performing well here, aside from the fact that we are rebounding from an extreme oversold condition. I mean, just look at what's happening with the price of oil. Look at what's happening with industrial commodities. The stock market has shown a little bit of weakness. We've seen a lot of weakness in emerging markets and commodity stocks in general. But gold is it's what I'm trying to say is, relatively speaking, it's held up very strong. The gold oil ratio has had a really good move. I mean, if you look at gold against copper, that's had a very good move. So I'm not trying to say I'm really bearish on the rest of commodities, but it looks like, gold is, I don't want to use the word decoupling yet, but, just to go in another direction, I think what gives some people pause is they kind of equate gold with, it's all one market, gold, commodities, gold, oil. If oil is going down and emerging markets are going down, that's bad for gold, which, in some points that can be bad for gold. But I mean, what I see here, Dave, is I think gold is really showing a lot of strength. Gold against oil, gold against the industrial commodities. I mean, it shows that the profit margins for gold producers should be pretty good coming up in the next 6 or 9 months. And if we get this new QE and we get increased monetization and bailouts in Europe, I mean, gold is going to be the first market to react anyway, anyhow. So maybe you could just give me your thoughts on the relative strength that we're seeing in precious metals, in particular gold, and perhaps if we could see some kind of decoupling over the next 6 or 9 months.
You mean with the gold stocks compared to the market, or the gold itself?
Yeah, potentially if you see, gold going up, the gold stocks going up, but not necessarily the other markets moving down, but maybe going sideways, and it takes them a longer time to
Yeah, yeah.
get going.
I was just clarifying. Yeah, I really believe this. Like, if you look at the day a few weeks ago when the Dow was down something like 270 points, and the gold stocks, I think, were up something like 6 or 7% that day. And I write another publication called Gold Stock Advisor, which deals solely with gold stocks, and it's associated with a website called Newsmax, which has a financial income money news. And anyhow, we have kind of we call it the brain trust meeting of all the people who write for the websites. And one guy said that he was bullish on gold, but not so much on the stocks because he feels that the stock market's in a topping pattern. And my comment back to him was, well, really, the S&P rallied about 20% or over 20% from the fall of last year into the spring of this year, and the HUI index fell over 30%. So I don't see that coupling anymore. I think that decoupled starting in the fourth quarter of last year. So I think that I think that what you said is very true, that we can now see this decoupling where the gold and gold stocks can rally, even though the stock market may not. Now, if we, even though we did have that day where the market was down a lot and the gold stocks were up a lot, if we get like a few days of intense selling, like happens in the summer of 2000 or in the spring 2010 or the summer of 2011, we'll probably see the gold stocks taken down at least one or two of those days. But for the most part, I definitely think we could see a decoupling, because I think part of the reason is just how cheap the stocks are. And it's not like 2008 or even 2010 and 2011 where the gold stocks rallied with, I think this is the major point, they didn't rally with the market this time. So it's not like, my gold stocks are up with everything else, so if the market goes down, I'm going to sell them with everything else. I think now you could definitely get money moving into that sector. And if you look at, I hate to say this, quote unquote, hot money, or that sort of thing, you could see, because Facebook has been a disaster and the whatnot, money that, say, was in, these social media stocks, which were a hot sector, could come out of that sector and go into gold because all of a sudden that sector is falling apart. And with us having less and less bubbles outside of, social media looks like it's popping, and then we have the bond market bubble kind of still brewing. But as these bubbles kind of dissipate, that is, in my opinion, going to bring more money into the gold market. Because the problem you can get is a competition for assets where, okay, if you're in your so-called flight to safety assets, and as long as the U.S. 10-year Treasury keeps rallying, there's no reason for people to look at gold as the safety over the 10-year Treasury. But if the Treasury starts to unravel, then that money can move into gold, and we can see rates go higher and gold stocks go higher, or the market lower and gold stocks go higher. I think the reason that we can see the decoupling that you're talking about is because, unlike 2008, when all the hedge funds and everybody was piling into gold stocks during the upward move in the market from 06 to 08, now we're not quite seeing that, and this money can move into gold stocks. We're not going to see forced liquidation, margin call type selling because nobody's in them.
Right, and it seems to me, you touched on the valuation point. It seems to me the only way that gold stocks the only way gold stocks and silver stocks, for that matter, would really struggle here, kind of go back into cyclical bear mode, would be if we get lower prices in the metals. Like if we see silver fall below 25, or if we see gold go below 1,500. I mean, that's the only way that we would see essentially lower earnings. And personally, I don't think that's going to happen. Would you agree with that?
Yeah, I agree with that. Sorry.
Well, because essentially, what I'm looking at, you look at these low earnings, and low earnings are great, but I think we have to not low earnings, excuse me, low valuations, very compelling valuations, but those are great only if earnings are going to increase, because valuations always look good right before the start of a recession because profits are high. And
well, I think that was the thing about, like, for me personally, even though I knew there was a financial crisis and a housing bubble, one reason I underestimated how bad the 2007-2008 bear market would be was because what you just said. The market was only trading at 17 times earnings as opposed to the 2000. And the 2000 bubble was the easiest one to call because the market was trading at 35, 40 times earnings, and the S&P was ridiculous because of all the dot bombs that had no earnings. So I think you're exactly right. Like now that we're only trading, say, about 13 times forward earnings, a lot of people are saying that is a reason to, that the market is cheap. Now, there are certain times, when the market's trading at 8 times earnings, there's very limited downside, but we aren't quite there yet. So, no, you're right. The part of the problem is the E is just too high. But I think with gold stocks, they're a special case where they're on the opposite end of it. Their P to E is low, not because the E is too high, but because the price has fallen too low. Like for example, during cyclical bull markets, maybe the 1994 bottom in stocks is an equivalent, or the 1990 bottom in stocks is an equivalent, where the market's just oversold and overshot the earnings to the downside. And what's really interesting, I know you were talking about the market maybe topping because but what's interesting about the gold stocks bottoming here is if you look at one reason that's hurt the price of the stocks, it's not just the macro side. It's the small side, like the related to companies, where companies have maybe had to shut down production in some major mines. In the mid 2000s, when it was apparent the high gold prices were here to stay, a lot of companies went on quote unquote mega projects, like trying to put multi-million ounce projects into production. A lot of those things have taken too long, have gone over budget. If you look at it, most of those companies are bringing those in online within the next year or two, and most of the over expenditure has now been accounted for. So we're also going to get some really good year-over-year comparisons in the gold stocks over the next year. And then, of course, with oil now falling back to roughly $80 a barrel, those are input costs. And with the rest of the commodity complex kind of more depressed than price in gold, that should help margins as well. So I think everything is set up where we've talked about the macro side and how cheap the gold stocks get. And, we're heading kind of into the bottom of the 4-year cycle, which was 2000, 2004, 2008, 2012 in these stocks. And then on top of that, the comparisons year over year in earnings in these things should be quite good going forward. And just one last note, you talked about the stock market and the low P to E. One interesting note, and I wrote an article for Financial Intelligence Report on this, is that no one takes into account that a lot of these major corporations have been able to borrow money. Like IBM and a lot of major companies, they can borrow money almost at government type interest rates, like 1 or 2 year bonds for 1%, or 10-year, 5 or 10 years out for 3-4%. So that lessening in the interest cost has actually increased margins to the point where margins are now at near record levels. So obviously it's very difficult for interest rates to go down from here. So unless they can improve top line growth, it's going to be very, very difficult for these companies to compete these huge margins. And then as soon as, even if rates just move up a couple points, that's going to cut into those margins, because some of the short-term debt, when it's rolled over, is going to be rolled over at a higher interest rate. So I think you look at all of those things and take that into account, that could also be headwinds for the stock market going forward. Now, I'm kind of still looking at the market peaking out more later this year or early next year. But yeah, definitely over the next year, I think we could see a topping pattern in the stock market.
Okay, now let's talk about, we have discussed some of the, I should say, micro fundamentals as to why, we could see a continued decoupling, why we could see gold stocks begin a cyclical bull market. And we're not saying the stock market's going to go down. We're just saying that we could see a top, a mild cyclical bear. Like Dave, you've been the first one to talk about that many years ago. But let's touch on some of the macro issues that could support that thesis. This Euro situation just seems to be a total mess. It's just a huge overhang that's affecting the markets every day. Dave, when do you think we're going to get some resolution to this?
Resolution to the Euro crisis and the whatnot?
Yeah, can you just discuss? Yep. Greece has some elections coming up. The market has reacted negatively to the bailout for Spain.
Because again, I'm saying resolution more to. Let me tell you what I think we're resolving, because I'm trying to decipher whether either the Spanish banking crisis or the Greek crisis, or there's so many crises in Europe going on right now. It's which one is going to resolve? I think what will really resolve the Euro crisis in the short term and maybe medium term, will be Greece essentially defaulting, going bankrupt, and then leaving the euro. I think this is good for both everybody involved. I think the problem is this: if you look at from just the pure like stat standpoint, Greece is the basket case. It can't be fixed. The debts are too high. They're not collecting their tax revenue. People are even more reluctant to pay taxes now because they don't want to basically just throw money at a bankrupt a government, or like, I guess you could say people want to get some kind of return on their tax money. When you see massive austerity, they're not seeing this. So it's just like a total basket case all around. And of course, their numbers continue to miss. So I think the European Central Bank really wants to do some form of monetization. They want to buy Italian bonds. They want to buy Spanish bonds. They want to buy maybe Portuguese bonds. And in the case of Italy and Spain, interest rates of 6 to 7% are not the end of the world. Yeah, interest rates at 10% are. So they would like to buy those bonds to get those interest rates back maybe down to the 5 to 6% range like they just were a couple months ago. I don't think they can do that. This is where Greece is the problem. Greece is very small. Greece becomes the problem is they don't want to have to say, well, we're helping Italy and Spain, and to a lesser extent Ireland and Portugal, but we're not going to help Greece. And then Greece is in the European Union, and Greece will say, well, how come you're not helping us? You're helping these other countries. Because Greece's 10-year bonds are at 30%. There's a big difference. Like, they're basically insolvent. So I think the European Central Bank would like to see some kind of resolution to the problem where essentially Greece defaults or is kicked out of the euro. Then they can just go into full gear and money printing and buy and do monetization of Spanish and Italian debt. So that's why I'm saying that Greece, I don't think brings down the euro, but Greece getting kicked out gives the European Central Bank a lot more flexibility to kind of help out with the rest of the Eurozone's problem. So I would say it's not so much doing something for the Spanish banks, which, there already has been a $100 billion, $126 billion bailout, or doing something for Italy. I just think that it's Greece being kicked out, which then gives them the flexibility to print money and help try to help all these other countries, and maybe some kind of bending by the Germans to do some kind of euro bonds, where then basically it would raise, the euro bonds would probably be higher than German costs, but they'd also be a lot lower than Italian and Spanish borrowing costs. And I think when people talk about euro bonds, people act like, oh, Italy and Spain are going to be able to, I don't think, borrow all their debt at those low interest rates. I don't think that's the point. The point is, allow Italy or Spain or some of these other countries, every country in Europe, to maybe borrow a third or a quarter of their debt at these lower interest rates, and that will help kind of like relieve the problem. And let's face it, when the European economy is the size of the American economy, so once you can buy euro bonds, it actually also brings competition to the gigantic U.S. bond market, brings something similar in size, and that will also help Europe as well. Now, just so you know, like philosophically, I don't know if I really agree with all this money printing and monetization and banking bailouts and all these things, but this is what I think is going to happen more than anything. And you can sit there and look at your Austrian economics textbooks all you want, but like that's not going to happen. There's not just going to be a bunch of defaults and let these countries go under. I think there's going to be, other than Greece, a real attempt to kind of patchwork this together. And also too, let's call a spade a spade. You may say just let these banks go under. That's the free market and this and that. But the TARP program in the U.S. was rather successful in terms of none of those major banks have gone down. Many of them have paid back a lot of that TARP money and have begun to recapitalize. So there's no reason probably why the Spanish banks can't do the same after, another few years. And you can argue the U.S. was actually, even though they didn't mean to be at the time, a little more forward-looking, because I think what this all comes down to, and Soros has talked about this is more of a banking crisis than a sovereign debt crisis. People aren't really worried about, like, Italy used to have double-digit interest rates with 100% debt to GDP levels. How come they could support that pre-euro, and now they can't even support 7%? Because people are more worried about the solvency of the banks to do exposure to real estate or sovereign debt than they are to actual countries going broke themselves. So I think once you shore up that banking sector, that's when you can move away from that. And I think the only way you can do that is if you let Greece kind of fail. That's why Greece is important, because once Greece fails, you can print money, you can bail out other European banks, you can buy your own bonds, you can do whatever the hell you want. But I think Greece has to get kicked out before that can happen, because there's such a basket case. It's just they're beyond repair. But you can actually help these countries that maybe can't be repaired.
Dave, aside from kicking out Greece, what do you think needs to happen for Germany to bend a little bit? I mean, do you think is it their economy weakening? I mean, is it more turbulence in just European capital markets? But do you have any idea on that?
I think the turbulence in markets would be like if all of a sudden you're getting like the 8 to 9% interest rates in Spain rather than the 7% or Italy. I think those things would really maybe make Germany wake up. And I think what would happen is if you saw a real significant slowdown, we're seeing that in Spain and Italy, but even more so. Like say instead of 1 or 2% contraction in growth, we see the 5, 6, 7% like we're seeing in Greece, or maybe not that extreme, but 3 or 4%. Germany will then realize, well, these countries buy all our products. We run huge trade surpluses with the rest of Europe. We have to do something more because it's in our beneficial interest to do it. I think that's the real key. The Germans have to realize, oh, the Euro bonds is not us bailing out the lazy Greeks or Italians or Spanish or these basket case economies. It's us helping ourselves by helping the neighbors, right? So I think that's kind of, that's kind of always been the idea. When Mexico had IMF bailouts, kind of the idea was, well, the U.S. is going to help that because that's a huge trading partner, and you don't want it to totally go down the drain. So I think that's the way it has to be perceived, that the Germans are doing it in their own self-interest and not to bail out a bunch of, backwards southern countries. Or there could be another resolution altogether where, you've got that northern euro with, Germany, Netherlands, and, in some of in the more stable northern European countries, and the quote-unquote Club Med euro, which ends up, the Club Med euro goes to par to the U.S. dollar or lower, and the northern euro goes to 150 or 160 or 170, ends up being a very strong currency. And that's kind of the most extreme resolution. But you could, I guess, if everything fell apart, you could see that happening as well. But really, Germans have to see that it's in their own self-interest. I would say that's the number one thing about it. And again, I hate to go back to it, but I think it all comes back to Greece because I think they have to leave. I think that is when people will feel more comfortable about doing this, because they'll look at Spain and Italy and again see that these are salvageable, but Greece isn't. And everyone can be more aggressive about everything once Greece leaves.
Okay, Dave. On that note, do you have any final comments you want to add before we close?
No, just that, like, in terms of, we started off, and me and you are both gold guys, and we try to keep this sometimes to a precious metals point of view. So, in terms of precious metals, I really believe, hopefully I'm not going to look stupid and just get sucked into a short-term rally, like happened, say, in like September of 2008, before the final leg down low. But I really believe that this precious metals market has made an important low, and the stocks can continue to outperform, and we're probably getting set up for a very nice, fourth quarter of 2012 and 2013. And the other points I didn't mention earlier, also the macro points that lead into this, is on top of maybe a Eurozone bailout and printing of money there, China just cut interest rates, India's cutting interest rates. Those economies are slowing down, but now that looks like they're going from a defensive mode into an offensive mode where they're going to begin doing, monetary stimulus and fiscal stimulus and all that sort of thing. And that's just another reason to really like the gold stocks and inflation plays going forward.
And let me ask you this: do you see the U.S. doing anything, or are we going to wait until there's some resolution in Europe?
I think the U.S. election. I think if it's like 2008 and things really fell apart even during the summer and fall, the Fed is going to act regardless of what happens in the election. I just think with the election, they become a little apprehensive because they don't want to look too political. So I would actually look at this June Fed meeting that's coming up in a few weeks, and I would think that if nothing is said at that meeting, and then barring a complete meltdown in Europe over the summer and into the fall, like happened in 1998 in Russia or 2008 in the financial markets, I don't see the Fed acting in an overly aggressive way until after the elections in November. They'll probably keep themselves open to more kind of easing, but I see some kind of QE occurring sometime in the fourth quarter. And I also think a lot of the QE will be, the end of the fiscal year in the U.S. is in the fall. And a lot of that QE will just be forced QE because the Fed has to buy that debt because the government can't fund. Look at the year-over-year purchases in Chinese in U.S. debt. It's actually flattened out a great deal. So the U.S. actually isn't really selling this debt to investors. It's basically they're going to have to continue to print money to buy their own debt. So that QE is happening.
All righty, Dave. Thanks so much for your time today. I really appreciate it.